All right, let's get right into it. Today, we're going to break down the core mechanics of strategic tax planning. This is the playbook that's used not just to pay what you owe, but to build serious multi-generational wealth, all by understanding the rules of the game. So, let's just start with a fundamental question. How do you see taxes? For most people, tax time is this thing to be dreaded, right? It's a bill, you pay it, it's painful, and you move on. But for people who approach this strategically, it's something totally different. It's not a punishment, it's a controllable cost. And that one little shift in perspective, well, it changes everything. Now, if you've ever started a side hustle or gone fully self-employed, you've probably felt this in your gut. You're working harder, you're making more money, but then at the end of the year, it feels like your tax bill just exploded. It grew way, way faster than your income did. You're not imagining it. That's actually built into the system. The reason you feel this way, it's real. It's especially true for side hustlers because you get treated like a full-blown business for tax purposes, even if you still think like an employee. The system just doesn't reward that. And it usually all starts with a nasty surprise, a tax most people have never even heard of until it hits them. And there it is, the self-employment tax. It's a flat 15.3% tax that gets slapped on your income before you even start calculating federal and state income taxes. Now, if you're used to a W-2 job where your employer pays half of that, this is a gut punch. It can absolutely turn what felt like a profitable year into a total tax nightmare. And that problem gets even worse because of one huge critical mistake. So many people just starting out pay tax on every single dollar that comes in the door, their gross income. But that's not how the system is designed to work. You're supposed to pay taxes on your net income. That's the money left over after you subtract all your legitimate business expenses. And when you make that mistake, you leave a mountain of money on the table. Every single business expense you forget to track, the mileage you drive to see a client, a piece of your internet bill, that software subscription you pay for every month. That was $1 you didn't have to pay tax on. When you don't track it, you're basically just giving the IRS an interest-free loan with your own money. Okay, so the big shift here, the real secret, is to stop reacting to your taxes in April and start designing your financial life all year long. And that begins when you realize the tax code isn't just a bunch of random rules meant to take your money. It's actually a map. Look, the experts, they don't see the tax code as a rule book meant to punish you. Not at all. They see it as a set of incentives. Think about it. The government wants people to do certain things, like create jobs, or build housing, or invest in energy. So what do? They write rewards for those exact activities right into the tax code. The wealthy simply align what they do with those incentives. And this right here is the perfect example of that mindset shift. The reactive person earns money, then they ask, okay, how much do I owe? But the strategic person, before they even make the money, is asking, how can I set this deal up to legally lower my tax bill? See the difference? Tax planning isn't something you do for a week in April. It's what you do all year long. This really gets to the heart of the philosophy. They're not afraid of debt. They're afraid of taxable events. That's just a fancy term for doing something that makes you owe the government money, like selling a stock for a profit. The whole game is to structure your life to trigger as few of those events as legally possible. All right, so now that we've got the mindset down, let's get into the toolkit. This is where we go from theory to actual concrete strategy. And it revolves around a famous 3-step playbook that's used to preserve and grow incredible amounts of wealth. You've probably heard of this one, even if you don't know the name, buy, borrow, die. It's maybe the most powerful long-term strategy out there. It's a 3-step process that lets you build up assets, use their value without paying tax, and then pass all that wealth to the next generation in an unbelievably efficient way. So, step 1 is simple. Buy stuff that goes up in value over time. We're talking about real estate, stocks, things like that. But here's the magic trick. As long as you hold on to it and don't sell, all that growth, that's called an unrealized gain, it's not taxed. Zero. You could become a millionaire on paper without ever sending a check to the IRS for it. Okay, so that leads to the obvious question, right? How do you actually live if you never sell anything to get cash? Well, that's step 2. You borrow against your assets. The IRS rule is crystal clear. When a bank gives you a loan, that money is not income, it's debt. So you can take out loans against your portfolio to pay for your lifestyle, and that cash is completely tax-free. Now, gotta be clear, this isn't a risk-free move. If the market tanks, your lender could demand you pay up fast in what's called a margin call. And on top of all that, the tax code gives investors, especially real estate investors, this incredible toolbox of goodies. Take depreciation. It lets you deduct a piece of a building's value on paper each year, creating a loss that lowers your taxes, even while the building is actually going up in real-world value. Or how about the 1031 exchange? This lets you sell an investment property and pay zero capital gains tax, as long as you roll all the money into buying another one. It's how people build massive real estate empires without taxes slowing them down.
Look, none of this is about just shaving a few $100 off your tax bill this April. This is about playing the long game. We're talking about thinking in decades, not in calendar years. It's about setting up a financial engine that builds wealth for generations to come.
And this brings us to the final step, the dive part. And honestly, a lot of experts say this is the most powerful piece of the entire puzzle. It's called the step up in basis. Let's say you bought a building for $1 million and it's worth $3 million when you pass away. Your kids inherit it, and for tax purposes, it's as if they bought it for $3 million. That entire $2 million in growth, poof, the capital gains tax on it is just gone forever. So the first thing people usually ask is, wait, what about the estate tax? Don't you get hit with that? Well, the reality is that the amount you can pass on without triggering the federal estate tax is incredibly high. For a married couple, it's projected to be around $30 million by 2026. What that means is, for the vast majority of people, this step up in basis is a very real and very powerful tool. So let's just recap that whole cycle, right? It's amazing when you see it all laid out. You buy an asset, it grows in value, completely tax deferred. You access that value to live on using tax-free loans. And then you pass it to your heirs, and all the built-up capital gain gets wiped away. It's a perfectly legal, self-reinforcing cycle of building wealth without getting hammered by taxes every step of the way.
So, when you really understand this playbook, it leaves you with a fundamental question. Are you just focused on building an income, working a job where your paycheck gets taxed every 2 weeks? Or are you playing a different game entirely, the game of building a legacy? The tax code lets you do both, but the rewards it offers for building something lasting, they are on a whole other level.